On November 6th, 2022, Sam Bankman-Fried was worth $26 billion on paper, all while running the second largest crypto exchange on the planet. He had Tom Brady on speed dial, his name on an NBA arena. A single tweet was posted, and 3 days later, it was all gone. $6 billion tried to walk out the door, and the entire empire vanished. The mystery here is, how could a $32 billion company collapse in just 3 days? To figure that out, we're going to walk through the 4 stages of Sam Bankman-Fried's crypto empire. A secret money glitch that printed low-risk millions, a God mode backdoor that quietly drained customer money. And it starts somewhere nobody would expect. Act 1. The Apprentice and the Glitch. Sam Bankman-Fried grows up with 2 Stanford law professors for parents, studies physics at MIT, and lands a job at Jane Street Capital, a top-tier Wall Street trading firm. At Jane Street, Sam is learning how to spot tiny gaps between markets, how to move money fast to close those gaps, and how to treat every decision like a math problem, not a feeling. He's reportedly making around $300,000 a year with a 7-figure bonus path. In normal life, that's "I'm set for a very long time" money. So why walk away? The story he tells is effective altruism. The philosophy says, don't go work at a soup kitchen, go make billions, then fund 1,000 soup kitchens. A college mentor, William McCaskill, pitches this to Sam over dinner. Sam buys in completely, signs the giving pledge, publicly commits his future fortune to saving as many lives as possible. Now, here's the problem with moral spreadsheets. If you tell yourself, if I get to 100 billion, I can save this many lives, then almost any shortcut today starts to feel justified. The bigger the promised good at the end, the easier it is to excuse sketchy stuff in the middle. Hold that thought though, we're going to come back to it. Now, we hit stage 1 of his money system. Find a glitch in the matrix. Early 2018. Crypto is big on headlines, tiny on infrastructure. Exchanges are clunky, banks hate dealing with them, and moving dollars around the world still feels like sending a fax. Sam notices something almost no one is positioned to exploit. Bitcoin is trading at one price in the US and about 10% higher in Japan. Imagine walking into a grocery store where apples cost $1 each on the left side of the store and apples cost $1.10 each on the right side of the store. Same apples, no reason for the actual difference. In traditional finance, 100 robots would sprint through that aisle, buy all the cheap apples, and sell them on the expensive side. In crypto, those robots didn't exist just yet. Sam decides to be the robot. He sets up Japanese bank accounts despite strict rules, reportedly using a native speaker to navigate the paperwork. Then he turns on the machine, buy Bitcoin in the US, send it to Japan, sell it for 10% more, and repeat. This is like finding a vending machine that accidentally vends $1.10 in exchange for every $1 that you put in, and running quarters through it all day until the repair guy shows up. Estimates put the daily flow of this trade around 25 million when it was working. Stage 1 was real. It printed low-risk millions, but it had a ceiling. Once the vending machine is fixed, that income stream dies. And Sam is not the kind of guy who makes $10 to $30 million and calls it a day. If you want to see how other operators use this exact same distribution to build 9-figure empires, hit subscribe. This channel is where we stop looking at celebrities as entertainment and start analyzing the money systems behind them. Every single week, this channel breaks down how operators build institutional wealth from unconventional starting points. Act 2. FTX. Owning the casino. Most normal people interact with crypto through apps like Coinbase. Connect a bank account, buy some Bitcoin, done. FTX was not that. In May 2019, Sam and his co-founder Gary Wang launched FTX as a derivatives exchange. Bet on price going up or down, use leverage, borrowed money to magnify your bets, and place complex multi-leg wagers across 100+ coins. This is built for pros, hedge funds, day traders, institutions. That's stage 2 of the system. Stop making money on the casino, start making money as the casino. The growth is insane. Revenue goes from 89 million in 2020 to over 1 billion in 2021. Now, here's where the model gets clever and dangerous at the same time. Stage 3 is print your own casino chips and pretend they're cash. FTX launches its own token, FTT. Think of FTT like casino chips that also act like store loyalty points, a stock, and collateral all at the same time. The promise is people who hold FTT get fee discounts and perks. FTX will use a chunk of its profits to buy FTT off the market and burn it. Less supply, more demand, and the price goes up. On a whiteboard, it looks brilliant. More traders means more fees mean more FTT buybacks and burns more burns means higher FTT price. But here's the catch. Imagine a casino that prints its own chips, stores those chips in a vault it owns, and then goes to a bank and says, look, we have billions in chips, lend us real money against them. And that's exactly what was happening with FTT. Alameda, Sam's trading firm, holds a huge pile of FTT, and because he controls both FTX and Alameda, he can say, these chips I printed equals valuable collateral. The token is only valuable as long as people believe in FTX. While that circular setup is forming, the reputation spray paint starts. FTX spends money like a 100-year-old bank. $135 million for naming rights to the Miami Heat Arena, now FTX Arena, Tom Brady, Steph Curry, Naomi Osaka as paid ambassadors, and even Larry David in a Super Bowl commercial. If you don't read financial statements, here's how that lands. If the NBA, Tom Brady, and the Super Bowl are cool with this, it must be safe. And then the serious money shows up. Temasek, Singapore's sovereign wealth fund, Ontario Teachers Pension Plan, Tiger Global, SoftBank, Sequoia, and more. Over 3 fundraising rounds, they put in more than $1.8 billion and crown FTX with a $32 billion valuation. Stage 4 is the part that turns this from aggressive to this can only end in handcuffs. He doesn't just bend the rules, he rewrites the software so the rules don't apply to him. Act 3, the secret backdoor. Here's what none of the investors saw and no regulator demanded to inspect. From day one, there is no clean separation between customer money and Alameda's money. In the early days, FTX doesn't even have its own bank accounts. If you wired dollars to FTX, your money actually landed in Alameda's accounts. By August 2020, FTX finally gets accounts in its own name, but the early customer deposits sitting at Alameda, they never get pulled back into a proper, segregated customer pool. Then, Sam decides to embed that chaos into the code. He tells Gary Wang, his CTO, to modify the FTX engine itself. The new code does 2 things. It gives Alameda a secret credit line up to $65 billion inside FTX, and it exempts Alameda from the automatic risk controls that every other user faces. Normally, if you trade on margin and your losses get too big, the exchange liquidates your positions to protect everyone else, like a casino taking your chips when you're out of cash. Alameda's account is coded differently. It's like typing in a cheat code on an old video game and turning on infinite health and infinite ammo. Their balance can go negative. The system won't auto-close their trades. FTX's code lets Alameda borrow real customer dollars against that collateral with no auto liquidations. If the market goes up, no one notices. If the market goes down hard, like it did in 2022, the hole appears. Gary later testifies in court that yes, he added special code so that Alameda could take and hold customer funds without normal limits. Now, mix in one more event, Terra Luna. If you weren't following crypto, Terra was a so-called algorithmic stablecoin, a coin that promised to always be worth $1. When enough people lost confidence and tried to cash out at once, Luna went to essentially zero. Tens of billions in value disappeared across the ecosystem. Alameda's trading book took billions in losses. Here's where it flips from shady to there's no way out. They don't have enough real assets to plug the gap, and from that point forward, every new dollar a customer deposits on FTX isn't just funding their account, it's secretly being used to fill holes from past losses. That's not a bad week. That is the definition of a Ponzi-like structure. And because of the God mode code, none of the usual alarms go off inside the system. The only thing that can kill it is someone big enough deciding the FTT chip is worthless and leaving loudly, which is exactly what happens. Before we get to the final 72 hours of the fall of the FTX empire, let's zoom out and see the complete system. Deposits. Customers send dollars and coins to FTX, thinking it's like a bank-level exchange. Fees and hype. FTX makes money on every trade. FTT issuance. FTX prints its own chips, promises to buy and burn tokens with profits. Alameda's God mode account. Alameda holds big FTT reserves, uses the secret credit line to suck out real dollars and coins belonging to customers. Speculation and spending. Alameda punts on risky trades and was ahead of the curve. Buys venture stakes in Anthropic, buys Bohemian real estate, donates to politicians, funds, and repeat. The same cash that should have been in a customer vault was being reused as trading capital, marketing budget, VC fund. There is no version of this that doesn't end in disaster. The only question is when. The answer, November 2022. Act 4, 72 hours to zero. On November 2nd, 2022, crypto news site CoinDesk publishes something that looks boring. A leaked balance sheet for Alameda dated June 30th, 2022. Anyone who can read a spreadsheet spots the problem. A huge chunk of Alameda's assets are FTT and other coins tied to FTX. The amount of actual independent liquid assets is way too small compared to what they owe. If FTT ever tanks, Alameda is toast. 4 days later, November 6th, CZ, the CEO of Binance, the largest crypto exchange in the world and an early investor in FTX, tweets that Binance is selling its entire FTT position, $580 million, due to recent revelations. FTT's price drops about 74% in a day. FTX users, suddenly spooked, slam the withdrawal button. Around 6 billion tries to leave in just 72 hours. This is a bank run. Just like in old movies, everyone shows up to get their money at once. And the bank doesn't have it because it already lent it out. On November 11th, 2022, FTX, Alameda, and 130 plus related entities file for bankruptcy. Over 1 million customers are locked out, and the estate estimates an $8 billion shortfall. This is where the was it bad luck or fraud question dies. In November 2023, a jury convicts Sam on all 7 accounts of fraud and conspiracy after about 4.5 hours of deliberation. In 2024, he's sentenced to 25 years in prison and ordered to forfeit $11 billion. And the cruel twist? The Anthropic stake Alameda bought with customer money, the AI company behind Claude, was sold during bankruptcy for about $1.3 billion. At today's private valuation, that same stake would be worth 25 to 30 billion. They also had stakes in Robinhood, a significant ownership in Solana, and a whole plethora of other great investments that were forfeited because of all of this fraud. If the structure hadn't been fraudulent, one of those bets alone might have covered all the customer losses and then some. Sam Bankman-Fried didn't blow up because crypto is cursed or because anyone who scales fast is a scammer. He blew up because he used real edge to earn trust, then quietly turned that trust into a blank check written against other people's money. If you want more breakdowns of exactly how empires are built and precisely how they fall, hit subscribe. And when you're done here, go watch our Elon Musk breakdown next.